these things put together made us very passionate about this project. And
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The consumer price inflation data for the month of July is set to come any moment now. Various polls suggest that CPI for the month of June is likely to be the highest in at least 6 months, and the relentless rise of tomato prices is seen as driving retail inflation higher. And joining me to analyze the data and the fine print is Saugata Bhattacharya, Chief Economist at Axis Bank, and Sujan Hajra, the Chief Economist at Anand Rathi. We are just counting down a minute to go at best, and I'll just sort of take you through the consensus view before I go to my guess once the number comes. CPI projected at 6.5%. This is the poll that we'll bring up on our screen. Around 25 economists pegging the number at 6.5%, and at this rate, the overall CPI index will rise 2 to 2.1% month on month in July, and this sequential rise will be the highest in at least 10 years. Tomatoes, that humble vegetable or fruit, depends on how you like it. Prices of tomatoes have skyrocketed over 236% month on month in July, and along with that, potato and onion also rose 9.3% and 15.2%. Okay, the July combined inflation rate CPI, breaking numbers right now, 7.44% versus 4.87% in the month of June. That's breaking news. Let's bring that up on the screen immediately. July consumer price combined inflation rate at 7.44% versus 4.87%. CPI food price inflation at 11.51% versus 4.55% in June. CPI rural inflation at 7.63% versus 4.78% in June. Urban inflation 7.2% versus 4.96%. This is a huge spike. The CPI combined index is up 2.9% on the month, viewers. I'll go through the numbers again. CPI for July at 7.44%. We have food price inflation at 11.51%. Rural inflation up at 7.63%. Urban inflation at 7.2%. Combined index up 2.9%. Food price index up 6.7% on the month. Saugata, coming to you on the headline numbers that are breaking just now. A very significant increase, far higher than even estimates, Saugata.
No, you're absolutely right, Siddharth. I mean, we were at 6.7% with some upside risk. 7% would have been expected, but 7.44 is definitely, I think, far beyond. I think there were one or two outliers in the polls. Very high numbers. So obviously, I mean, this is not just tomatoes. This, as you mentioned, covers a whole range of food, vegetable, cereals, etc. But I wouldn't be surprised if even core inflation, which we were expecting about 5%, turns out to be higher. So this is definitely a very negative surprise.
Okay, as we bring up the data for CPI and stay with that graphic on the screen, quick comment from you, Sujan, on the main numbers that you have heard so far.
So obviously it's extremely surprising. We had penciled in a number which is closer to the consensus 6.5 kind of a number. So it's almost a whole percentage point higher than what was expected. As Saugata said, this cannot be just because of tomato or even just because of food. there must be other components also which are involved in the process. For example, if you look at core goods inflation, which was a concern even earlier, maybe there has been some uptake there also. Overall, very disheartening set of number which is coming out.
I have some more numbers for you, and I'll just read them out, viewers, and then we will get our economists to comment. I'll also request my producers to stay on the headline numbers for now. The CPI vegetable index is up 38% on the month. Pulses and products index is up 2.4%. Oils and fats index is down. That's the only down that I have read so far. Food beverage index is up 5.7%. There's an uptick in housing prices. Fuel and light index is up 1.8%. Clothing footwear index up 0.3% as well. And cereals and products index is up 1.2%. The miscellaneous index up 0.4%. So all across Shogato, there is a very significant price build up, and vegetables contributing to that. The index up 38% on the month, Shogato.
No, you're absolutely right. So, I mean, vegetables is something, and given the broad basing, I mean, rather than just tomatoes, as you mentioned, across cereals, fruits, other ginger, chilies, whatever, garlic. We know we have seen this throughout the part. Potato prices also up. Rice prices, and you know the reason for worry. The good thing is that prices of tomatoes in the Maharashtra markets yesterday was down 37%. So I think it's beginning to normalize with the imports from Nepal, reported imports from Nepal, etc. But the worry is that this is now broad basing itself into a much wider basket of commodities, both agriculture and otherwise. Remember, globally, due to various factors, the Black Sea embargo and other prices, food prices are going up, have gone up fairly sharply. Petroleum prices, oil in particular, which is a very key transportation fuel, and which is also going up. So given all of these factors, the ingress of global food price inflation into India, and the general the worry about El Nino, then now uh, expected to influence edible oils, palm oil prices later on in later months. So the price pressures that are building up, both externally and domestically, does not augur well for a very sharp reduction in the overall food inflation basket.
Some more data, Sujan, as I come to you, and if we compare it for the basis of a better understanding, uh, within vegetables which have seen this build up on the wholesale basis, for the wholesale price index, we was not the CPI, we saw an astonishing 307% increase month on month for tomatoes. And on the whole, vegetable inflation, if we compare it on an annual basis, rose 62% versus a negative 22% in June. Now, there is a price build up even at the wholesale level, Sujan, and then when you pass it on to retail, there is obviously going to be not just a natural seasonal price build up, there will be profiteering, there will be black marketing, there will be hoarding. Do these numbers therefore mean that even the government policy makers, the RBI, must have been taken by surprise by these numbers, because they do have some early indicators of these numbers before they are released to the public?
My sense is that in the specific context of the monetary policy, the MPC members are perhaps aware of a number during the point of policy decision. What I think is that the thinking in the policy circle is that at least the food price part of the inflation is pretty much transitory, and supply sided efforts will be taken so as to ensure that food inflation comes down. See, so far as the food prices in India is concerned, with the exception of a few, for example, edible oil, for example, pulses, all of the prices are more or less domestically decided.
Right.
And government generally has a better lever to control the domestically decided prices. So therefore, my sense is that while there are reasons to be concerned about overall inflation and food inflation in particular, but the food part of the inflation is more likely to revert to the seasonal part by the next couple of months. So
Okay.
while I remain concerned, but I don't think this is a very big risk as of now.
Okay. Shogato, you had spoken about the core bit. The core numbers are also with me. And for your response, core inflation 4.9% versus 5.1%. This is sequential. But the big headline, and I'll request my producers to bring that up on the screen, CPI inflation for the month of July at a 15-month high. CPI inflation is now at a 15-month high. Our experts are telling us, and the data shows that this is concentrated in a particular kind of price spike. But Shogato, what should we make of these numbers, especially that 15-month high number that's right up there in our face now, Shogato?
So I'm actually a little bit more concerned about the implications, the broader implications of this number that has just shown up. Remember, the RBI MPC projection for Q1 was 6.2% for the second quarter. That obviously will not hold anymore, because given our 6.7 forecast for the month of July, our next month, August month's forecast was 6.3%. It is likely to be far higher than 6. So, I mean, the MPC RBI projection of 6.2% average inflation for Q2 will probably no longer hold. Governor had an ominous statement, you remember. I agree with Sujan. I hope these numbers are, as they say, idiosyncratic, transitory, etc. But Governor did mention that if these numbers are not idiosyncratic, then MPC, and it turns out to be more persistent, then MPC will have to act. Remember also, amongst all the other farm inputs that we had been discussing, prices of fertilizers, urea, DAP, MOP, etc. So all of these fertilizer prices have begun to increase globally. So that's a very key input into farming and food prices, etc. So if the government has to give out more subsidies, if not directly on inflation, this will have large fiscal implications, because the government will have to spend more. And if the fiscal thing increases, the whole range of interest rates will begin to rise, particularly the SLR papers, etc. So those will begin to rise. I mean, basically the implications. I'm very happy that that core number has turned out to be lower than we had projected, 4.9%. But it's
Shogato, sorry to interrupt you. Explain why should we read more into that core inflation number being lower on a sequential basis?
So core inflation is the one which is more sticky, which is more persistent, because the drivers of core inflation are more in the nature of a demand-led inflation, particularly services component of core. Is stickier, and the non-core, which is the food and fuel prices, they vary. I mean, they move up and down, are more volatile. So I mean, it's not as dangerous to read into that 11% or the 7% inflation, the food inflation or the headline inflation, as it is in that 5% core inflation, because that 5% number, if it sticks there,
Correct.
will make it more difficult for the headline inflation to trend downwards, as the RBI says, to align durably with the 4% headline inflation target. Makes it more difficult. So that's why our focus is more on core, because it's more a reflection of demand rather than supply shocks coming into the system.
Okay. We also have the number for within this index, the overall vegetable inflation, and I'm struck by the fact that the increase that we saw in vegetable prices as captured by WPI, it's almost the same, 37% in the CPI. So there is very clearly a full pass-through happening. Sujan, how would the RBI now be responding to this? Because that's the big question at this stage. This is data that's in the past, but what is now the future response going to be?
In the previous monetary policy, governor had very clearly said that he doesn't want the inflation within the comfort zone of 2 to 6%. He wants the inflation close to 4%, which is the 1 point target. So now with the inflation going up in excess of 7%, that number reverting close to 4% anytime soon becomes very, very unlikely. And at any case, it was unlikely even before this on a persistent basis. So therefore, I think from the RBI side, there will be immense amount of pressure. The MPC will be to at least do a token rate hike of 25 bips. So I think the path of least resistance is another 25 bips rate hike, and then look at the data for the next 4-5 months. Fortunately,
And
we'll
and
get
and when out of policy hike, Sujan, is that what you're saying?
No, I don't think RBI will go for out of policy hike, because despite the fact RBI clearly stated that this is more of a transitory, the food part of it. So I think they will wait for at least another data point to see whether it's really transitory. And Sugato was also mentioning the same point. I think they will remain in course of the policy. And if the next number also anything above 6.5, I think they will go for a rate hike in the next policy. That's my take.
Shaugato, your take on what Sujan said. Should we now be talking about a hike, even if a token one?
I somehow don't foresee a hike if the core inflation remains around 5% odd. If oil doesn't shoot through, go above 90, or some of the other factors, say even fertilizer prices, for instance, I somehow don't think the MPC and the RBI will try to stem. These are bad optics. I mean, I completely agree with Sujan on this, that the optics are not good. But I don't think they will resort to interest rates, which are a very broad, blunt policy instrument to try to quell food inflation. I think it will be more a matter of trade policy, fiscal policy, managing stocks, etc., imports of the target the commodities, vegetables or cereals, etc. But my sense is, unless it begins to persist, so that the 10, 11, 32% or whatever inflation tends to persist over the next 2 or 3 months, then they will be forced to act, because the fear is then this will then diffuse into the broader basket of commodities. So
Okay.
without barring that, I don't somehow think the balance of probabilities that the MPC will not raise
But
rates.
even if a hike is not on the table, at least for 2-3 months, and you're pointing out the fact that the RBI also seems to have been prepared. The recent statement also alluded to the possibility of a spike to whatever extent. The fact that the rate cut cycle, which was being spoken about till just the other day, is now further away in the horizon. When I spoke to economists, people were saying Q4 of the financial year or Q1 of the coming calendar year. Are we now looking at summer or even beyond, or you wouldn't want to hazard a guess at this stage?
No, I think I completely, totally agree with you that I think the higher for longer is now completely baked in. Remember, this was even before this print that's now come in, the CPI print. In the last policy, the Q1 FY25 forecast of the MPC RBI, the inflation forecast was 5.2. At a 5.2% average inflation for Q1, it was impossible to envisage a rate cut, even in Q1. So my sense is now we can safely assume that the top of the cycle and then the cut would be postponed to the second half of FY25. Of course, I mean, things can change very quickly. I mean, we don't really know what kind of, if the West deflates, if the West goes into a recession, if China's growth prospects become very, very poor. So all of these are factors that need to be looked at, that we don't know now. But the base scenario that we have is probably the first rate cut will only happen around the second half. And remember that actually when we talk of rate cuts, given the resilience that we are seeing in India's economy, growth, aggregate demand, etc., there is really no case for a rate cut at this point in time. bank credit demand remains strong, aggregate demand remains very strong, core inflation is sticky, services inflation coming down but still sticky. So really, I mean, talking from a macroeconomic perspective, there is really no case for a rate cut at this point in time.
Absolutely, and Shogato, I'm wondering what is now happening on the drawing boards, because Reuters had polled 53 economists, and obviously none of them expected this to happen. It's such a surprising, such an adverse number that no one had imagined this. A slightly broader question to you, Shogato, before I go back to Sujan as a quick follow-up. You spoke about second half of FY25. How much more of a pressure are crude oil prices, which aren't being passed through to the consumer but are building up at one level before? How much of that will add further pressure, especially because we are going into busy election season as well, Shogato?
No, crude oil remains a worry, because remember, one of the key reasons why markets were beginning to price in a rate cut at some point in time in Q4 and with lower inflation numbers was there was a widespread expectation that crude at about $70 to $75 a barrel would enable the oil marketing companies to begin cutting their petrol and diesel and other pump prices. With oil now looking to be around in the $80 to $90 range, I think that is probably out the window. Don't think that is happening. So that will immediately keep prices at a higher level. So that's one. On top of which, if actually crude and other petroleum product prices begin to increase, and that might actually lead to a hike in petrol and fuel prices, and that is the worry. And this feeds into that entire petrochemical complex, including fertilizers.
Absolutely. Sujan, add to this debate, the monsoons have been a bit irregular. We saw a rather more than anticipated initial phase. Now there's a bit of a stall. The vegetable supply chain broadly has gotten impacted, and we still don't have clarity. Tomatoes is again just one very visible headline grabbing item, 1400% increase in the last 3 months. But prices all across the basket are going up. Every year climate change is becoming an issue. The broader question therefore is, how can monetary policy react and anticipate such shocks, Sujan?
No, that's a very valid question. But so far as RBI is concerned, RBI's viewpoint has always been inflation is ultimately a monetary phenomena. So therefore, it really doesn't matter whether it's core or non-core, whether it's food or non-food. Ultimately, if you treat high inflation without any policy intervention, this gets percolated to the non-core gets percolated to core, food gets percolated to non-food, the wage price spiral. So therefore, RBI's viewpoint is pretty clear. Inflation is a monetary phenomena, and there is a certain level of tolerance which RBI can exercise in response to supply-sided inflation. But beyond that, RBI has to act, because if inflation is a monetary phenomena, it has to be replied with monetary policy action. So from that perspective, RBI, if the current level of high inflation continues, even mainly because of the food items, RBI has to act sooner rather than later. So that's my view. I don't think that the possibility of a rate hike is really off the table. And if inflation persists, RBI won't have much option but to go for at least another symbolic rate hike.
Okay. Bad news for our markets. Very clearly, some of the comfort and the bubble that had been created around inflation has been pricked, and has been pricked very, very badly. Shogato, if you were a market participant, and I'll let you have the final word on the show today, would you be discounting these numbers, or would you be looking to, with your finger on the button, the moment trading opens tomorrow?
I definitely. I mean, I can't talk about equity markets. I mean, shouldn't really. But on bond markets, there will be a very adverse reaction to this. I agree with Sujal that I mean, we can't take a rate hike off the table completely. I mean, it's not a zero probability event. It can happen. But my guess is, as you saw in the last policy, that they resorted. I agree with Sujal that inflation is largely over a period of time a monetary phenomenon, and that's why they clamped down on liquidity. So that liquidity thing that they were promising to revisit on the 8th of September, that is again gone. That will persist longer than that. So what they were likely to do, and which is why I'm saying in the bond markets tomorrow, is remember liquidity had gone down below the repo rate onto the near the SDF rate. Now they will try to push it up all the way to the MSF rate, which is near the 6.75%. So that's one way that they will try to control, and that obviously, if the near term goes up, that will have an automatic impact all across the various tenors of the yield curve, and so there will be an adverse reaction to this in the bond markets.
Okay, today was Monday, the beginning of a fresh week, and we are headed into celebrating one more Independence Day. Many people have taken the extended week, including Monday off. I got Shogato and Sujan to speak with us for the past half hour or so. Clearly, we would have been happier discussing a much lower number. This is not a number that gives anyone comfort, and certainly not the policy mandarins, and obviously you, the end consumer. Because remember, inflation, while it may be a whole lot of mumbo jumbo data and statistics, at the end of the day, it pinches you and pinches the poor the most. And that is why it's called the worst possible tax on poor, and India has a big burden of those people who are not as economically fortunate. So the latest numbers from July, a shocker, a wake-up call, hopefully a transient one, but already, as both economists on the panel have explained, there will be immediate consequences of several sorts. Shogato Bhattacharya, Sujan Azra, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics, where we have decoded the latest July inflation numbers, and tomatoes have very clearly spoiled the party. Thank you very much for watching.